And the article I'm working on is a summary of a lot of the points I've mentioned in recent videos, which is essentially I feel the market's going to head higher into the election for the following reasons. And every one of these reasons I'll get into more detail later in this video. But the following reasons: because there's very little distribution, the major indexes are above their key moving averages, the Fed, the leaders are acting well, and I'm going to get into tons of stocks as well later in this video. And also because I feel that President Trump will do everything in his power to keep an equity-friendly environment to get reelected. This is not a political statement. It's a common sense statement, meaning that any politician who wants to get reelected will do everything in their power to get reelected, including keeping pressure on the Fed and possibly doing various tax cuts, again, to keep markets in an equity-friendly or even a propped-up environment. Now, here are a couple of counterpoints. I am flexible in my approach. I am open-minded. And if any warning signs come up, such as increased distribution or the leaders breaking down, I'll do my best through these twice-a-week videos to present them to you. And of course, if anything comes up in between the videos, as I've done in the past, I will email all the members if there's anything alarming or anything very important that I feel I want to pass along. The other counterpoint is I've noticed some of the sentiment measures are getting a little bit too bullish. NAIM, I don't like how that's been high for 4 consecutive weeks. A lot of equity call buying. CNN Fear Greed's ticking up a little bit higher. So some of them are ticking up a little bit higher. And my feeling is what the market's going to do along the way, just to keep the bulls in check, is we're going to have these shakeouts and quick pullbacks just to keep the bulls in check, to shake out some of that bullishness as we see a little bit more excess. How I'm handling it is I've noticed this pattern that I discussed as a daily chart of the NASDAQ Composite is since I identified those follow-through days for you in early April. It was April 2nd for the S&P 500 and April 6th for the NASDAQ Composite. We've seen this roughly 8 to 12-day pattern of running up, pulling back to the 21 EMA. Sometimes it goes a little bit longer than 8 to 12 days, but we have these quick shakeouts. Again, just to kind of keep the bulls in check, kind of like when you think you're too smart and you think it's easy, the market will punch you in the face just to remind you and keep you humble. And I even mentioned it in recent videos how we were starting to get a little bit extended a couple of weeks ago, and we had a pullback. And again, it's not always going to be exactly to the 21 day, but close to it. And how I'm handling it is taking some profits when we get a little bit extended and keeping some cash to buy on the pullbacks. That's why I always encourage people to define yourself, whether you're a trader or you're an investor. If you're an investor, do your best to get strong entry points and deal with the volatility. If you're a trader, as I am, maybe take some profits into strength and have some cash for the pullbacks. That way, when we do pull back, number one, you don't get hit as hard, and number two, you have some cash for maybe some stocks you are looking to buy rather than panicking out. You have some cash to be sound-minded and maybe put to work on support. Now, if you can't watch the market as closely as I can, or if you're working full-time, or you maybe have a longer-term time frame, then I encourage smaller positions. That way, you don't have to be stressed out about these pullbacks, and as I mentioned, get stronger entry points and try to let some of your profits run and give these stocks a little bit of room. Now, part of what I'm trying to do through this product is promote, calm and confident trading. And for example, one strategy, I know some members have told me that they're worried about a bigger correction or they have a lot of cash. So one strategy, for example, is you don't have to be all in. You can be, for example, 50% invested. The way I look at it is, if you're in a basket of a lot of these high growth stocks that have a beta of 2, meaning they're going to move twice as much on the upside and on the downside as the markets, if you have a 50% portfolio, and let me just reset the lines here. For example, we've seen some of these really quick 1 to 3 day, 6 to 8%, pullbacks in the markets. We've seen these ugly reversals where we pull back. if we pull back, let's say 5%, and you are fully invested in a bunch of growth stocks that have a high beta, you could drop 10% in a short period or more if you're on margin. That's why I'm saying if you are, let's say, 50% invested, that way that keeps you calm and, kind of, curbs a little bit of your fear, so to speak. And if we get the pullback, you don't get hit as bad. That's why if you are, let's say, nervous about a correction, or you can't watch the markets as closely, smaller positions. Now, you might say, that's not good enough. I want to make tons of money, and when the market goes up, I want to be fully invested. Again, there's nothing wrong with that. Just keep in mind, some people have different risk tolerances, and some people don't have the stomach for bigger corrections. If you do, obviously do what works for you. But the key is, just to remind you, the key is I'm trying to promote longevity. I'm trying to promote being calm. I'm trying to instill confidence and create disciplined traders. And as I've mentioned several times, I do feel that as individual investors, we have huge advantages over the big institutions. And I do feel you can put together consistently 20 to 30% returns on an annual basis if you have the discipline, if you know what to look for when the market is healthy. Obviously easier said than done, and to be in the right stocks. And then when the warning signs show up, that's where the key comes in, to have the discipline to reduce your exposure and avoid some of the bigger corrections. But the point is, there's nothing wrong with smaller positions and not being super, super aggressive and just putting together slow and steady returns. Because if you can put together 20 to 30%, and that's not, something crazy or completely unreasonable, if you could put that together, the key word is consistently, let's say over 5, 10, 15 years, then, as they say, forget about it. You're just going to really, really compound your account. But again, the key, it involves a lot of hard work and involves a lot of discipline. And I'm doing my best through this product to keep you on the right side of the markets and present those warning signs when they show up. And again, the article that I'm working on will hopefully be out early this week, and I'll tweet it out as soon as it's ready. So let's jump right into index review and go over a bunch of stocks.